Before I ask my questions, I just want to respond to some of the things some of my colleagues put forth as statements or theory or postulates in saying that the problem that we face really is there's too much regulation, and some of them said it in different ways. I would just like to analogize that if we had a superhighway system for use of mixed vehicles, different kinds, cars, trucks, etc., and there were speed regulations, a lot of speed regulations, and nobody was enforcing the speed regulations because the state police just neglected to patrol or find anybody who was speeding. And suddenly, systemically, the entire highway system is filled with crashes and carnage. Is the problem A, that there are speed requirements, B, the police are not patrolling, or C, the people trying to figure it out are from outer space? Or feel free to add D, all of the above. I think we're getting into an area here where we're talking about philosophy versus fact. That's my observation. A question. Mark to market. Where there is no market, and arguably sometimes there is no market, how do you require companies to mark down the value of their company, setting off all kinds of crises in the economy, and expect there not to be problems? Anybody?
I'll take a pass at it here, Mr. Ackerman. I come at it from the experience of the savings and loan debacle, the creation of the RTC, and the resolution of property owned by the U.S. taxpayer as a result of closure of significant numbers of institutions. Real property was sold for about 20 cents on the dollar, notes and securities for 12 and 13 cents. It was a contained geographic downturn in Louisiana and Texas, and the residual economic effects of that distressed sale in that environment caused a decade-long downturn in those regional economies. To a great extent, it was brought on by, in essence, a mark-to-market philosophy. Let's get the stuff out the door at a emergency price. At the same time, I would be quick to add, however, efficient market function only comes with accurate disclosure of values. And there will be a very difficult decision to be made by someone in an administrative agency as to how to proceed with government-owned resources in the current environment. If a bank is to liquidate an asset and it is below whatever value is on the books, they'll have to raise capital in a very tough marketplace to offset that material loss if they expect to have it sold. And
which is why the banks are holding on to all that money we gave them.
To a great extent, that is a contributing factor. There would be others better able to respond to that observation than I, but I would also suggest that in order to sell that asset in a difficult market at above book value is very problematic for the acquirer because he knows he's not paying market value. So this is going to be a continued and long-term problem of resolution. I cannot dispute the fact your observations have merit, although I would say that to act without true valuations and allowing parties to come to a negotiated price on any asset disposition, we could not expect that to be the end conclusion either. Dr. Vaughan?
Yes, if I can just speak to this from an insurance perspective a little bit. I have found myself for the last year or so rethinking myself around this subject of mark-to-market, because I would say that a couple years ago I tended to be thinking that movement, that direction was a good thing. When you hit a world like we're in today, where the liquidity situation is so difficult, and we know that the market values of these assets are depressed for two reasons. One is there are real credit losses coming down the road. But second, there is a depression in market values simply because of the liquidity of the market. We don't know what the mix of those two is. But to force companies that are going to hold these assets long term that don't have to sell in this illiquid market, to force them to write down to a value that reflects current illiquidity, I am wondering, again, just sort of thinking through it, whether it's sending the wrong signal to the marketplace, and particularly I think about consumers. Is it sending the wrong signal to consumers about the capital that is in these companies and how strong these companies are? There's a lot of, one of my colleagues likes to say the greatest risk we have right now is a crisis of confidence. It's that people are scared, and we know our policyholders are scared, and so that's one of the reasons that the insurance regulators have really been struggling. What kinds of reporting requirements should we be having in this environment right now, where the markets are not anything that we've ever lived with before, and not in my lifetime?
We can't address, or we certainly can't legislate confidence in the market. We're going to do a lot of cheerleading to do that. But in addition to that, if I may, for a couple of seconds, Mr. Chairman, just say that among the risks of the system, I would think you have loopholes which we can do something about, greed which we can do nothing about, and within greed there are things that we can do to eliminate the loopholes, which include things like reinstating the uptick rule, where people, for reasons of their own, beat down the value of a company to take advantage of the system to make lots of money, while distorting the real value that there might be in a company or in the marketplace. Thank you, Mr. Chairman.